Hello everyone, this is the review video for your stock quiz or your chapter 13 quiz. The first thing you should know is the difference between your issued shares and your outstanding shares. Shares that have been issued mean the company sold them to the public at any point in time. The difference between issued shares and outstanding shares is outstanding shares are those number of the shares that were sold that the public still has in their hands. Companies will sometimes buy their own stock back from their shareholders. They call this treasury stock. So you can think of shares outstanding as the number of shares issued minus the number of shares the company holds in treasury. Shares issued, however, are what gets reported on the balance sheet. And to figure out what the reported value of these shares issued is, you simply take the number of shares issued and you multiply it by the par value of each share. It gives you the reported value. So if a company had 1,000,000 shares that were issued and the par value listed on each share was $5, well, that means that they would report a value of $5 million. And because this is a simple linear equation, if you have any two of the variables, you can always solve for the third. If we knew we had a reported value of, say, 5 million and 1,000,000 shares issued, well, you would take that $5 million reported value, divide it by the number of shares issued, and you would arrive at that same $5 par value. What is par? Well, par is the minimum amount that the company is allowed to issue shares for in the future. It is an antiquated concept, but we still need to put it on the books. The reason we need to put it on the books is because we are required by GAAP to separate at the time we issue shares the amount that went towards par value and the amount that can be attributed to the excess that our shareholders paid above a stock's par value. So let's say on January 1st that ABC Company issued 100,000 shares of $5 par preferred stock, and they issued these at par value. So not a price above, they're issuing them for $5. Well, for the journal entry, we would first fill in our date like we always do. The debit would be to what we're receiving for issuing these shares, which is going to be cash, and it's going to be for a total of $500,000. How did I arrive at that number? Well, it's the number of shares being issued times the sale price. And since we're issuing at par, the sales price is $5. Our credit would be to the equity account that we have, in this case preferred stock, with a $5 par, and it would be for that same $5,000. Our description would say that we issued preferred shares at par. When it gets reported on the balance sheet, just focus on the top line. You're going to tell your investors what type of stock it is and any other important details, which is for preferred stock is the percentage that is guaranteed in dividend payment, the par on that stock, and the number of shares that the board of directors has authorized, the number of shares that your company has issued, and the number of those shares that are still outstanding. So our company has preferred stock with a 6% stated rate, a $5 par. The board authorized 250,000 shares, and 100,000 of those shares were issued. They are all still in the hands of the public, so they're all still outstanding. Again, we report at our price of shares issued times par. 100,000 times $5 par is where the 500,000 next to preferred stock comes from. What if we issue shares above par? Let's say on January 2nd, ABC Company issued 200,000 shares of $1 par common stock, and they're going to do it this time at a value of $10, which is common. Companies typically issue new shares well above the stated par price. We fill in our date. We debit what we're receiving for issuing, which is still cash, and the amount that we are going to debit it for is $2 million. Again, how did I get here? I took the number of shares being issued, which is 200,000, and I multiplied it by the sale price. And we're selling these at a market value of $10 a piece. 200,000 times 10, we're getting $2 million in cash for issuing these shares. We're going to have two credits to two separate equity accounts. One is the portion that is attributable to the par value of the stock, and one is the portion that is paid in excess of par. So our first credit, let's put it to our common stock $1 par. Well, how much are we going to credit this for? 200,000. How did that number come about? It is the number of shares being issued times par. We have 200,000 shares issued. $1 par means 200,000 is going to be our credit to common stock $1 par. Our other credit is going to be into our paid in capital in excess of par account for common stock. That is way too much to write on a line in a journal entry, so I recommend that you abbreviate it to PIC common. I don't know if Pearson will let you do this, probably not. It is your paid in capital in excess of par account. And that is for the difference between the amount that went to par and the amount of cash that we received, which is $1.8 million. We could, however, figure that out by taking the number of shares issued and multiplying it by the difference between our sale price and the par price. We had a sales price of $10 a share. We have a $1 par price. That difference is $9. If you take that $9 and multiply it by 200,000, you get 1.8 million. Our debits equal our credits. Our journal entry is looking good. We just need to throw in a description, and that description is that we issued common shares above par. When that's reported on the balance sheet, it's going to have two separate lines. The first line is for the portion that went towards par. That is our common stock, $1 par, 1 million shares authorized, 200,000 shares issued and outstanding, gets credited for $200,000, and our PIK common account gets listed as $1.8 million. Total paid in capital is the sum of all forms of money that came into the company from outside parties. So all of our stock issuance, we have $500,000 for preferred, $200,000 in common stock, and $1.8 million in PIK common, for a total paid in capital of $2.5 million. For preferred dividends, the formula to figure out how much dividends you are paying your preferred shareholders is shares outstanding times par value times the stated rate on your preferred stock. It gives you your total preferred dividends that you are going to pay. So let's say that ABC Company declared a normal annual dividend on its 6% $5 par preferred stock. The rate on preferred stock is always for the year, and since we're using an annual dividend this time, we're just going to use that same rate. So at the time of this declaration, there was 100,000 shares outstanding. That is what we're going to throw into shares outstanding. We're going to multiply it by the par value, which was $5, and we're going to multiply all of that by the stated rate. The stated rate was 6%, so 0.06. When you take 100,000, multiply it by 5, and multiply it by 0.06, we realize that ABC Company is going to declare $30,000 worth of preferred dividends. Common shareholders get paid too. Usually comes in two forms. Typically, companies will say we're going to pay a fixed amount for each common share that's outstanding. In this example, I used $1, so $1 per share. If you needed to figure out how much your dividend declaration was for common shareholders, and they use this methodology, you would take the number of shares outstanding and multiply it by the dividend rate per share. But we're going to look at the second way, which is where a company declares they're going to pay a certain amount of dividends in total. So that goes to preferred shareholders and common shareholders. Preferred shareholders always get paid first, so you can think of how much goes to common as the total amount that was declared minus the amount that's going to preferred shareholders is whatever's left over becomes your common dividends declared. So if ABC Company declared $100,000 worth of dividends, and we know from the last slide that the total amount of preferred dividends that were declared was $30,000, well then common shareholders have $70,000 left over for dividends. So they would take the $70,000 divided by the number of shares outstanding, and that gives you how much of a dividend goes to shareholders for each share that they own. To journalize this declaration of ABC Company declaring $100,000 in total dividends, we're going to fill in the date, which is December 1st. Our debit is going to be to a withdrawal account, and that withdrawal account is called cash dividends. That is going to be for the total amount of the declaration. In total, they're declaring $100,000 worth of dividends. We're going to make two credits to two different liability accounts. One for our preferred shareholders. The amount that we've already declared we're going to pay to preferred shareholders in this example was $30,000. And we know from the last slide that the amount that is left over to go to our common shareholders is going to be $70,000. And we declared cash dividends. When we pay these dividends, and in this case they're paying them on December 31st, the entry is to get rid of those liabilities on your books. So you're going to debit your dividends payable account for the same amount that you put on the books in the last entry. For preferred, it was $30,000, and for common, it was $70,000. We're actually paying the dividends now, and this is the point where cash leaves our company and goes into the hands of our shareholders. So we're going to have a credit to cash for $100,000. We didn't declare the dividends this time, so our description is that we paid cash dividends. Retained earnings is the portion of a company's profitability or their net income that they hold on to. Companies will be profitable for a period. Shareholders expect to get a portion of that profit because they are technically the owners of the company, but companies usually don't pay out every cent of profit they made to their shareholders. They pay them out some, and then the rest they hold on to so they can buy new equipment, so they can launch new product lines, so they can expand their business footprint. So to figure out the amount of their earnings that a company is retaining, you simply take the amount of net income that company had during the period and you subtract out the amount of dividends that you have declared that you're going to pay to your shareholders. Let's say the ABC company had $600,000 worth of dividends during the year, or $600,000 worth of net income, during the year. Well, if we take that $600,000 of net income and subtract out the dividends that we just declared in the prior entries, which was $100,000, that means that ABC company must be holding on to $500,000 of that income. They're retaining, if you will, $500,000 of that income in their retained earnings account. Retained earnings is still an equity account, so when you put it on the equity section of your balance sheet, you're going to tag it in under your total paid in capital. So your paid in capital is going to be broken into the different types of stock you have and any associated PIK accounts. We already did this and determined the total paid in capital for this example was $2.5 million. If we take retained earnings, our other form of equity, and add that to the $2.5 million, we find out that ABC Company's total stockholders' equity was $3 million. Good luck.